You need to create the circumstances for a melt up in the markets, but underlying it, you also need to have a narrative, a story that investors latch onto. And of course, 25 years ago, it was the growth of the internet. Today, it's the growth of AI, artificial intelligence, and also with a bit of crypto spice thrown in. So, I mean, there are stories which investors are latching onto.
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined today by Tom Stevenson, Investment Director here at Fidelity, to ask whether we are entering the final stages for this bull market. There are some worrying parallels between today's market and the period that led up to one of history's worst market crashes, but are the doomsayers right to warn of trouble ahead? Tom, welcome along. Before we get going, I will say at the start that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussions in the comments if you want to do that. It really does help people find what we're doing here, and it means that you'll get new content as it is released. That said, now, Tom, I won't go as far as saying that you are one of the doomsayers. But you did write this week that there is a historical comparison that is looking quite interesting right now. And you warned that investors may even have been taking leave of their senses. What period were you talking about?
Yes, I mean, when I referred to investors taking the leave of their senses, I was referencing the late 1990s, the what we know as the dot-com bubble, when share prices skyrocketed, often on the back of not a great deal of substance, and inevitably that period in the markets ended pretty badly. Now, I mean, I think there are some similarities between then and now, and what I was really focusing on in that piece I wrote was the period actually just ahead of the sort of final, what I described as a melt up in the markets. And quite often you get this at the end of a long bull market. The animal spirits, are running free, and people are very optimistic and enthusiastic at the end of the bull market. They've had many years of rising markets, can't really see, problems on the horizon. And the comparison that I made was with 1998, which was actually about 2 years or 18 months ahead of the end of the market. And what we had then was we had a correction in the market, and the Federal Reserve, the US central bank, responded to that correction in the market by cutting interest rates. And with the benefit of hindsight, it was actually the wrong thing to do. They were cutting interest rates into what was essentially a pretty strong economy. So it kind of, the way I described it was it poured fuel on an already smouldering fire. And that's what kickstarted this final push up in the markets, which ended badly. Now, the reason why I was writing about it this week was that, of course, the Federal Reserve cut interest rates last week. And there are some signs that maybe the labour market is slowing down a little bit, but there are also signs that actually the economy is actually in quite a strong position. And I just questioned, whether we might look back on this and think, was that the moment when the Federal Reserve actually made a mistake and fueled a final push up in the market, which would end badly. So I was drawing some power. I mean, and we'll come on to this, I'm sure, but there are quite a lot of differences as well between then and now. Yeah,
there are. It's not actually the most recent major market crash, is it? That probably came in 2008.
That's correct. Yeah,
but that was different. And so we are going to come on to some of the ways in which now might be more similar to the dot-com era. But just for context, how big was that fall in the dot-com crash?
Well, I mean, the stock markets fell by about 50%.
Over a long kind of period of time.
Well, it was over a period of about 3 years.
Yeah, painful. Really
so between
long and painful.
2000 to March 2000 to March 2003, Yeah, it was long, grinding losses. I mean, watching your investments fall for 3 years consecutively is really brutal, and it's it's painful to watch it, and it's very difficult to behave in a rational way when that's happening. And I do know many people, because I lived through that period, and I was sort of active in writing about the markets and active investing as well myself. And many people just got very dispirited and disheartened towards the bottom of the market. And of course, that's, as we know from a sort of behavioral investing perspective, that's precisely the time when you should be optimistic. But it's very hard after 3 years of losing money to be optimistic.
Yeah. And talking of behavioral irrationality, you spoke about this melt up that can happen. Surely part of that story, and you feel this as an investor, is that returns, it becomes too good to miss out on what's going on in the market. The returns, and we're deep into this now. How many years of double digits? This is what, 2 years already. This year looks like the same. It feels like you can't afford to not be in the market. But I think even everyone will share sort of concerns, or there was to spot dangers, but you just don't want to be outside of it.
Totally.
And miss this sort of leg up, even if something is around the corner. Yeah.
So I mean, the way I look at it is we're actually in a bull market within a bigger bull market. So the markets bottomed out in 2022, nearly almost exactly 3 years ago. They've been rising strongly for 3 years now. 2023 was a strong year in the markets. 2024 was strong. 2025, after a big wobble in April because of that tariff shock, has also been another very strong market. I mean, since April, markets have been super strong. And that sits within a much longer bull market that really started at the financial crisis in 2009. We had 16 years of this. The psychology is, it's very difficult to stand back from that and say, do you know what? I think markets are actually getting a bit toppy now. I'm going to reduce my exposure. When you look all around you, everyone else is making money. Things are shooting up, and you look at some of the things which are going up, and they happen to be the more speculative, the riskier stocks. Maybe they're companies that aren't actually making a profit, and you think, really? And then you look at what they've done. I mean, for example, I looked at some US shares which had done very well. Coinbase, a cryptocurrency exchange. Robinhood, a trading platform.
All benefiting from people taking risk, basically.
And they have gone up serious amounts of money since April. Both of those stocks have more than doubled, 3 times. I mean, that's a ridiculous pace of growth in 4 or 5 months, and it just it does create echoes of what happened in 1999, and that's really was the prompt for me to write that piece.
Yeah, it really speaks of sort of momentum, doesn't it? Let's dwell just a little bit on the Fed side of this and that interest rate decision. Obviously, they cut rates. They have said that presumably they see slowdown in sort of economic data. You hear this more and more about the US economy. Some of the jobs data is being revised in a sort of more negative direction. Construction is weak. Lots of sort of things that would be kind of bellwethers for general growth aren't looking very positive. But at the same time, there can still be inflationary forces within the economy, and you'd normally associate that with a kind of an upswing. So what's exactly going on there?
Well, I don't know. It's the short answer, and I think no one does, and that's the issue. I mean, if the economy is genuinely slowing, then it makes sense to cut interest rates. But if interest rates are being cut for other reasons, and there are other reasons, there's a political imperative to cut interest rates. We know that. We know that the Federal Reserve is under political pressure to keep interest rates low, partly because of the high level of debts that the US government has incurred. If rates are being cut when they shouldn't be cut because inflation is still a problem, and inflation is still above target. We're talking about a situation where company profits are actually pretty strong at the moment.
Yeah.
Yes, there are early signs of a slowdown in the labour market, but company profits are still growing at sort of high single digits or low double digits rate of growth. That doesn't immediately feel like a situation where you need to give the economy a boost. So my concern at the moment is not that we're heading into a recession. My concern is that we may be making the wrong policy decisions, which ignite a frothy end to the bull market.
And do you know if that's what happened all the way back in the dot-com boom? They obviously cut rates then into a sort of more inflationary environment. Did we then see that inflation?
Yes. So what happened was that interest rates were cut 3 months in a row at the end of 1998 in response to this collapse of there was an emerging market currency crisis. There was a collapse of a big hedge fund. The central bank was concerned that this would cause a systemic problem around the financial system. So they cut interest rates in September, then again in October, then again in November. Actually, unemployment was low, inflation was still, quite high, and it just fueled this growth in the economy and in the stock market. And quite quickly, the Fed reversed course and it started raising interest rates through 1999. But, the cat was out of the bag by then and the boom had started.
Yeah. And just finally on the kind of macro central bank stuff, what's complicating the picture now, presumably, is tariffs, because they are inflationary. The Fed is sort of saying it's a one-off, or we're going to look through it, or it won't cause sort of secondary effects, as they would call it. That's a call, isn't it? They're making.
The Fed has been quite sensible, I think, in as much as it has sat on its hands for most of 2025 to try and assess what the impact of tariffs would be. And they clearly made the decision now that actually the threats to growth are more significant than the inflationary threat. So they've made that call.
They spoke about companies eating it, as in that jargon, basically companies are sucking it up. So maybe it's a hit to company profits, but they're not necessarily passing it on sort of in the full version.
Yeah, but that's not yet showing through in the earnings. So it is possible that they've read it wrong and they've cut too early. We just don't know.
Yeah. Okay. There is probably a more obvious comparison between the dot-com era and now, and that's to do with technology.
Yes, absolutely. I mean, one of the, you need to have the circumstance, you need to create the circumstances for a melt up in the markets, but underlying it, you also need to have a narrative, a story that investors latch onto. And of course, 25 years ago, it was the growth of the internet. Today, it's the growth of AI, artificial intelligence, and also with a bit of crypto spice thrown in. So, I mean, there are stories which investors are latching onto. I mean, we talk about AI all the time now. It's such an integral part of our working lives and our personal lives as well. It has become such a powerful story for investors that it feels to me that it has the potential to be what fuels this growth. And we have certainly seen. Not just in the US, but even in China too. We have seen one of the strongest markets this year has actually been the Chinese market, and it's really been fueled by enthusiasm for Chinese tech stocks and AI focused stocks. So it's a global story.
Yes, you and I have spoken before on the podcast. We don't need to kind of go over all of it, but a lesson from the dot-com boom and then bust was that ultimately predictions of the internet revolutionizing daily life were correct, but from an investment point of view, that didn't translate into gains for the companies that people assumed would win, and the timescale was different, right? I mean, it was probably, you could argue, not until maybe 7-8 years after that, when we had smartphones and we had all sorts of technologies to really unleash the internet, that was when some of the kind of the bigger predictions started to come true, the situation might be the same with AI. The companies that we assume are going to drive things now, very exposed to AI now, might not be the eventual winners.
Yeah, both of those points are absolutely right. The timing is uncertain. The identity of the winners and losers is uncertain. The third thing that's uncertain is what is the appropriate valuation to attach to these companies. And here, actually, there's an element of sort of cautious optimism, because if you look back to 25 years ago, some of the valuations were, clearly absurd. These were non-profitable companies with no prospect in the short term of making profits that were being valued extremely highly by the stock market. What we're seeing today is that the perceived winners, the likes of Nvidia and others, in the US, in China, elsewhere, are actually profitable businesses, and they are, they're making decent earnings, and therefore the valuation multiple, the multiple of earnings that you're having to pay as an investor, is high, but it's not ludicrously high.
Yeah.
So I think that's an important distinction between then and now.
Is that changing as the market does grind higher and higher? I mean, there was a lot of attention on Nvidia's results a few weeks ago. There will come a point, won't there, that the valuation looks less reasonable?
Yes, I mean, I think it is changing a little bit, although as we saw in the most recent results round, I mean, the results from these companies are still very strong, and they're still growing very strongly. I think what is a similarity with last time, and this is what's changed maybe a bit over the last 6 months or so, is that the boom is broadening out. And I mentioned some of those more speculative stocks which are starting to be valued very highly. We haven't had that over the last couple of years. We've had very strong markets, but I would say it's been justified by performance and by earnings. I think we're moving into a market where it's the market feels less sort of moored in reality, if you like. It feels a bit more, wishful thinking is kicking in a bit more than it was maybe even 6 months ago.
So you mentioned about where we might be in the cycle. 2008 might be a parallel. That would leave what, 2 years of growth?
1998, not 2008. Yeah,
sorry, 1998. Yeah, you're right.
Yeah.
We're probably taking this whole comparison a little bit far, but the point I would make is that 2 years, the final 2 years of a bull market, you don't want to miss those.
Exactly right. And that is the challenge for an investor, because you absolutely don't want to miss out on the final stage of a bull market, because that's when it sort of turns up the page and becomes more vertical. And actually, that is that's a dangerous time, but it's also a rewarding time for investors. You want to be a part of that. And I think, my next challenge as a commentator and observer of the markets is to work out, how to manage that transition as the market does rise, how to reduce your exposure in a measured way, which allows you to participate in the final burst of enthusiasm, but doesn't leave you heavily exposed. And that is much easier said than done, because most investors don't do that, because the longer it goes on and the higher it goes, the more difficult it becomes to withdraw.
Yeah, and presumably don't take any, you talk about reducing exposure, but don't take that to such an extreme that it amounts to an attempt to time the top, right? Because you won't. Yeah. And none of this is an instruction or an invitation for people to sell their investments, because we don't know. And that's always the problem, isn't it? And to put some of the other side of this, it occurs to me that if we're going to look at that comparison from 1999, 2000, there was a kind of economic sort of monetary reason why markets slow down. Then there was 9/11. Then there was some wars, and there was a whole bunch of things that the market is not going to take very well. And for that kind of crap, I mean, it would be touch wood, a crash from a 50% crash from where we are would be really, really, really seismic. And it doesn't feel like, central banks getting things wrong a bit is necessarily going to account for all of that.
No, absolutely. And I'm really keen not to convey the sense that I am telling people to get out of the market, because I'm absolutely not. I genuinely don't know. All I'm trying to do is to make some observations about the market and to think about managing my exposure to risk. And also another point to make is that your tolerance of risk will differ depending on where you are in your life cycle of investment.
Exactly.
Now, for me, I'm thinking about this from the position of someone, who is, in my early 60s and really very keen not to lose the money that I've managed to accumulate.
Yeah.
Now, if I was in my 30s and I was setting out on that path, I would look back at what happened in 2000 and I'd see where the stock market was then, and I'd see where the stock market is now. And I think, well, do you know what? Even if I'd bought at the top, I'd be looking fine now.
And it's always instructive, isn't it, to look at the chart over very long periods of times, because these seismic events, and they absolutely were, charts lie to you a little bit in this respect, but they just become gentle undulations in the bigger picture.
And at the time, they don't feel that way. At the time, they feel pretty scary and terrifying. But you do have to step back and think about the long term. Or you need to accept, well, I'm at a different stage in my life, and maybe it's appropriate for me to have a less risk exposure. But you can't sort of make an across the board observation that makes sense for everyone.
No. Okay. Well, Tom, that is just about all the time we have for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means you'll get updated content as soon as it is released. Give us a like or share episodes. It really does help people find what we're doing here. That said, Tom, thanks for joining me.
Yeah, thanks, Ed.